What's up everyone, it's Caddy with MoneyVest. So in this video we are going to be talking about tomorrow's meeting with the FOMC. So the meeting started today, and tomorrow at 2:30 p.m. Eastern is when the press conference is from Jerome Powell, Chairman of the Federal Reserve, and at 2 p.m. Eastern is when we're going to get the statement released along with the summary of economic projections. I will be live to cover the entire, basically the FOMC meeting, and of course the announcement during that time. As always, if you enjoy this video and find it helpful, make sure that you drop a like, and of course subscribe to the channel if you're just joining us for the first time. And the links to our Discord and Patreon is also going to be down below if you're interested in joining us, and of course getting access to all the members only private videos, including all the trade alerts and trade ideas, as well as all the options alerts and our MoneyVest.com website that's going to be launching very soon that I'm super excited about. So again, link's going to be down below. So this right here is a survey that was done recently, and there was expectations for a recession that have gone down significantly, and soft landing probabilities have increased from the previous surveys as well. So the average probability of a soft landing was 52%. That's up from 47% in this survey, and the probability of a recession in the next 12 months is down to 32%, down from 39% in January and 63% in November. So that's basically been cut in half in terms of how many market participants believe in terms of a recession this year. Now, the potential downside of a better forecast: less Fed easing, with the possibility that officials at their meeting this week forecast fewer rate cuts in 2024 than they did in December. For now, the narrative that the U.S. economy is still so fragile that it cannot survive without ultra-low rates has been debunked and discarded into the rubbish bin of history. This was John Donaldson, Director of Fixed Income at the Haverford Trust Company. And the March survey finds that the average probability of soft landing is at 52%. With the first time that it has been over 50% since the question was first asked in July, and the probability of recession in the next 12 months fell to 32%. Now, I really disagree with this. The narrative that the U.S. economy is so fragile that it cannot survive without ultra-low interest rates has been debunked and discarded into the rubbish bin of history. I kind of disagree with this because, you know, when you look at the economy, it's a very, very slow-moving machine, right? So when interest rates actually go up or go down, the interest rates going down, the effect of interest rates being cut is significantly faster than the effect of interest rates moving higher. Because when interest rates go down, they go down much faster, right? They go down in an instant because the Federal Reserve, let's say they're trying to fight a recession, they're trying to fight high levels of unemployment, so they cut interest rates really quickly. They do a lot of quantitative easing very quickly, and that gets reflected in market expectations, in consumer behavior, in financing activities, in borrowing activities, and that happens very, very quickly. But when interest rates go up, they don't happen instantaneously, right? They happen slowly and steadily and gradually that we got to this level. And as a result, the economy is such a slow-moving machine that it takes time to get accustomed to higher interest rates. So the fact that the U.S. economy is so fragile, with higher interest rates being a big sort of a significant impact on the overall economy and the unemployment, is still yet to be seen. We cannot declare victory just because rates have been higher for, let's say, a year and nothing hasn't happened yet. Right? Nothing's broken, or the economy is still strong, unemployment is still strong. And there's a specific reason for that, because there's been a significant change of transfer of wealth from the public sector to the private sector, and that's exactly what Ray Dalio has also mentioned. There are specific reasons for that, but you keep interest rates high enough for long enough, believe it or not, there will be problems in the economy. There will be things that start to break down. I mean, SVB is a great example of things actually breaking down in the financial system when rates are higher for longer. And in my opinion, I think if things continue to stay this way, if the Federal Reserve, let's say, does not cut for another year and a half, then we'll talk where unemployment is and where interest rates are causing a bigger impact on the overall economy. Now, this was Scott Wren, Senior Global Market Strategist at Wells Fargo Investment Institute. He says, and I quote, "The U.S. economy continues to move towards a modest growth and modest inflation environment. This may take longer than initial expectations, but the trend is favorable." And when it comes to rate cut forecast, they still see 3 rate cuts this year on average, which would bring the federal funds rate down to 4.6%. That's exactly what they have kind of mentioned in their summary of economic projections. And survey respondents never became as euphoric as futures market about rate cuts, and so they haven't had to backtrack from the 6 cuts that the market priced in. Even then, there are those who believe the Fed could be more hawkish at the upcoming meeting. I honestly do believe that there is a possibility that the Federal Reserve dials down on the potential rate cut expectations in 2024, considering that yes, inflation's coming down, but it's not coming down at the same rate as it was previously. And this right here, of course, speaking of inflation, with more growth comes only modest inflation reduction this year. The consumer price index, forecasted to fall down to 2.7%, down from the current level of 3.2. It is expected to fall to 2.4% next year, but equal to the Fed's target of 2% for PCE index, because CPI is believed to run about a half point above PCE, and the unemployment rate expected to take up to 4.2%, but stays there through 2025. Mark Zandi, chief economist at Moody's, says the Federal Reserve has all but achieved its goals on full employment and low and stable inflation. The Fed should declare victory and begin to slowly cut short-term interest rates and wind down its quantitative tightening, and the balance sheet runoff, or QT, is now forecasted to end in January compared to with November in the prior surveys as well. Now, I think it's really going to come down to what exactly is the Fed's target, is the Fed's goal, right? Previously, they've mentioned that they want the inflation to be running below 2%, so it kind of averages out at 2%. In the past, they've mentioned that they will let it run a little bit hotter than expectations, or what their target is. All they're looking for is a trend down to 2%. And of course, in some cases, they've said that the inflation needs to be at 2% before they can get that greater confidence to start cutting interest rates. So really, they keep moving the goalpost back and forth. It's not like they're moving the goalpost farther. They're just moving it different directions so that we're not able to fully understand that what exactly is going to be that metric or that trend or that direction where they can actually start to feel confident that, okay, now we can start cutting interest rates, because inflation is coming down. There's no doubt about it. It has been coming down. It's down from over 9% from 2022 to now 3.2, 3.4%. Core inflation's, again, still a little bit above the Fed's target. So it is moving in the right direction. So the trend is good, but we're nowhere near close to the Fed's target. So does that make the Federal Reserve confident that, okay, just because their trend is good, can we start cutting interest rates? In my opinion, not so much. I think it is going to have to be closer to 2.2, 2.4% on a year-over-year basis before the Federal Reserve finally says, okay, we've kind of achieved our target and we are close to achieving our target, and we can start dialing down on interest rates and start cutting. Now, I've also mentioned in my previous videos, let me just pull that up here very quickly, what my expectations are with respect to tomorrow's meeting. And I've made a slight change in those expectations because, of course, as we know, that the Federal Reserve is already pricing in for 3 cuts in their summary of economic projections. So this is going to be the rate decision. So again, tomorrow, very, very important day. This is going to be one of the most important meetings because we've also got the summary of economic projections to accompany with the actual statement. So we already know that, there's about a 98% probability that the Federal Reserve is not going to do anything. No rate hike, no rate cut. If we unexpectedly see any type of rate cut, which very, very unlikely, the markets, of course, are going to be very bullish. But it's really just the guidance for 2024 that's going to hold a lot of weight in tomorrow's meeting, and that's what's really going to cause the markets to react in a certain way. If we get any type of rate hike expectations or less than 3 cuts, meaning 2 cuts or 1 cut, I think that would be very bearish for the market. And I'm kind of sitting in the camp of maybe even possibly seeing fewer than 3 rate cuts in 2024. I'd be surprised if they actually come in at 4 or 5 rate cuts in 2024, because even the market right now has kind of aligned itself with the Federal Reserve expectations that, okay, we're actually going to only see 3 rate cuts. So it's either going to be kind of reiterating 3 rate cuts in 24, or there is a possibility for fewer rate cuts. I mean, I am willing to accept that I will be or I could be wrong if they come in with 4 rate cuts or more. So let me know in the comment section down below. I really want to know from all of you. What do you think in their SEP, Summary of Economic Projections? What are they going to put in? Are they going to put in 4 rate cuts or more? Or are you expecting fewer than 3 rate cuts in a 2024? Of course, if we reiterate at 3 rate cuts, that's pretty much expected. That's what the market's also pricing in. So that could be a very neutral and non-reactionary sort of day. And again, all of that is going to then come down to what Jerome Powell says during the press conference. But this is strictly from an SEP standpoint. And if we see fewer than 3 rate cuts, which I do believe, in my opinion, has a more than 50% probability of happening, then that could actually trigger a little bit of a sell-off in the markets, and we could start to see that downtrend after being, overbought and overextended for long overdue here. But let me know in the comment section below, what do you expect from a guidance standpoint, more specifically the guidance of 2024, and I would love to know from all of you in the comment section down below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Again, tomorrow, very, very important day. I will be live to cover the entire FOMC meeting, the press conference. Everything is going to be discussed. And as always, happy investing. I'll see you all in the next video. Check out the links down below if you want to join our MoneyVest community.